Welcome. Using this heat map, we utilize the power of over 25 financial metrics to gain a multi-perspective view of the markets, from bonds, stocks, commodities, and Bitcoin. In this video, we'll review the past week's trend movements using our metrics heat map.
Looking back to our prior update last week, we discussed some constructive developments in week 44. The Federal Reserve meeting sparked a wave of optimism that the central bank might start tapping the brakes on its aggressive rate hike pace. This provided a bit of relief to battered markets after a grueling year. But fast forward to this week, week 45, and some conflicting cross-currents have emerged to muddy the outlook again. We've seen mixed signals arise around inflation expectations, bond yields, and other key indicators. Specifically, in week 45, the University of Michigan report showed consumers' inflation expectations have actually been creeping higher recently, and expectations remain split rather than anchored. So the risk of expectations becoming unmoored poses a huge concern. The Fed is laser-focused on inflation expectations as an early warning light. Because if expectations for future inflation drift upward, it can turn into a self-fulfilling cycle. Shoppers hasten purchases expecting higher prices, workers demand bigger raises, expectations shape actual mindsets and behaviors. In essence, if the public starts bracing for 5% inflation down the road, their preparations can actually help generate and validate that 5% inflation. This kind of reinforcing wage price spiral is what the Fed desperately wants to avoid. Unanchored expectations like the 1970s can be extremely tough to wrangle once they take root psychologically. So far, the Fed still thinks expectations look contained for now. But if the Michigan survey keeps showing an upward drift, the Fed may have to get a lot more hawkish again with rate hikes to nip it in the bud. Markets reacted negatively to the auction and inflation outlook news. Stocks dropped while Treasury yields rose across the curve. Just like that, the hope coming out of the Fed meeting was replaced this week by renewed uncertainty. In the background, money has been shifting out of the Fed's reverse repo facility into Treasury bills. Reverse repo was like a parking garage for excess cash during the pandemic. But now higher T-bill yields have attracted trillions of dollars back out. This liquidity flowing from the Fed into the banking system could have constructive implications for the stock market. When banks have ample cash reserves, it can prop up stocks in a few ways. Easier lending conditions. More reserves mean banks don't have to fight as hard for deposits to fund lending activity. This greases the wheels for credit growth and economic activity. Potential stimulus effect. Some investors see the rising bank reserves as a form of monetary tailwind or loosening financial conditions. This perception alone can lift investor sentiment and risk appetite. Reduced funding stress. Plentiful bank reserves lower funding pressures in the banking system. This relieves a weight on banks and generates more confidence in the financial sector. So while the mechanics are nuanced, the net effect may be supportive for equity valuations. Stock markets tend to benefit when liquidity is free-flowing versus constrained. Even if the economic impact is hazy, the signal of easy money could buoy psychology among stock market participants. Bitcoin had a solid week pumped up by progress toward a spot BitcoinETF approval, and crypto sentiment generally seems to be thawing in concert with other risk assets. So in sum, conflicting undercurrents in markets and the economy persist. Inflation remains the key variable now for where rates head next. Data over the coming months will be critical to whether pricing pressures are moderating as hoped. If clear easing in inflation doesn't materialize, the Fed may have to keep hiking well beyond current levels. But if disinflation takes root, the Fed could shift to rate cuts sooner than markets anticipated, and that policy pivot would provide a massive boost to the markets. Through our market and metrics analysis and patient execution, our trades this year have been very positive. We identified timely positions in uranium and Bitcoin, entering in sync with market trends. Now we've got our sights set on a promising new opportunity, the VanEck Semiconductor ETF. This technology sector shows compelling potential if we can identify the optimal entry point. Of course, robust risk management remains essential, and we must maintain realistic expectations, as no investment is guaranteed. For now, we will patiently monitor price action and market developments. That's the end of this week's market summary. Goodbye and see you next week for more market insights. If you enjoyed this market update, you can check out the full 2023 heat map spreadsheet in the video description below. Alternatively, feel free to explore the charts on your own. I've obtained a special discounted link for TradingView that's in the video description.
If you found this video summary useful, please give us a like or consider subscribing. We truly appreciate comments and feedback. That's it for this week's summary. Have a good day.